Now, as we pivot into the third segment, we really want to look at some of the flash data. So S&P Global Flash US PMI initial read for October. PMI came in, the composite came in at 51 versus the estimate of 50. So again, some of that additional expansion. Manufacturing came in at a perfect 50, which just means no increase, no decrease, kind of holding firm. Estimates for 49.5, and that's something that we had been expecting, is some of that little bit of a bump in coming back. We do see this fading into Q4, but again, this is something that is a positive. While services, we expected it to come down a bit, but again, not fully below 50. And here instead, it went from the expectation of 49.9, bounced up to 50.9, which again is just showing how we're just kind of hanging in. And that's supported based on what we've seen with some of the leading indicators when you look at inventories as well as prices, because that increase is technically negative, but has a positive contribution to where we are. Cost burdens rose at the slowest pace in 3 years. Price hikes in selling prices also softened. But the key piece is they came down, but not in a way that it's in contraction, just a little bit of that pause, because as we've said, there's going to be that ebb and flow that we're going to continue to see. Convergence happening between the manufacturing and service input prices, which is what what the Fed doesn't want to see, because the hope was that manufacturing input prices would stay negative or at least flatline. Instead, they're reaccelerating, and service prices are coming down a bit. But as we said, they were going to meet in the middle. Our view was that by this point in time, they were going to be meeting somewhere closer to a stagflationary, slight deflationary footprint. Instead, they're meeting well above that, with some indications that you're going to get that little bit of additional bounce higher in input prices. New orders on the manufacturing side came into growth, which is a net positive. When you look at input prices, they came down, still expanding, but still came down. Same with prices charged. But when you look at PPI had a bounce. So the question is going to be, okay, this is one piece, PPI is another. And this is that confluence of the back and forth, that chevron pattern, if you will. We do see this being fairly sticky, but as we said, it's just going to be a matter of who did you ask, when did you ask, what area are they in of the economy, and that's going to be a derivative or directly correlate to how they see things in general. But again, all of this is a good thing to see in comparison to the PPI, which showed 2 months of acceleration. So earnings reaction is fairly lackluster when you look at the median outperformance of beats, and people are taking advantage of beats to essentially just lighten their position. So good news, it was expected. Let's take some of the risk off the board, because let's be fair, depending on when you got in, you made a lot of money in the equity market. So now you're looking at this and saying, all right, well, rates are going up, geopolitical risk is increasing. The 2-year to 10-year is trading between 5 and 5.5%. I mean, that's a pretty good return if you think about it, and try to take some off the sidelines, especially when you look at household view of inflation is less rosy than the markets, because the household is seeing that pressure point. So if you're looking at this and saying, all right, well, from a household perspective, I got in, time to get out, get some of that income, and the view of inflation, again, coming all the way back to segment 1 in the first chart, you've seen the pain points on food. You've seen the issues that continue to come up on the credit card side, and again, that's the problem point of the whole backdrop. The other key piece, when you look at the previous charts that we talked about, when you look at input prices for manufacturing, it's also important to recognize that those surveys were taken when diesel prices were still coming down. Now they've actually reversed higher again. What is that going to do to the underlying and the bigger issues in general? Sales of CLOs plunged. Appetite for CLOs decreased after 2021. Year to date, this is something that isn't overly surprising. US CLO resets look set to drop from previous years. Resets largely vanished as AAAs remain wide. Again, it's just because you're not being incentivized to go out and again, just borrow to go into these CLOs because there's no benefit because rates are too high. Can you carry that leverage ratios? Does it make sense to go after more cash flowing entities? And that's where we have to really look going forward. Then when we look at the business outlooks, supply and price related stress eased in October for the Philly Fed Manufacturing Index. Delivery times remain in contraction and are hovering near the lower end of the range. But again, the prices paid, it bounced, but it's going to stay there. It's going to bounce around, and you can see that flatlining. Then you look at September retail inventories, as we said before, coming in at 0.9 versus the estimate of 0.2. But look at the level. It remains elevated. The last month it was 1.1%. Now it's 0.9. Wholesale inventories are fairly flat. So you're seeing that drift up because people aren't buying to the same level. And as that slowdown increases, that's where you see that pressure. It takes time to have that move through the system, which is why you can get some of these delays where you're like, well, the economic data is getting a bit worse, but yet Q3 GDP was better. And this is because, again, it takes time to see these things get factored in because and remember, inventories actually is a net positive when you look at the GDP calculation, but it also shows the slowing consumer. So here you had a positive bump in inventories and a strong surprise move up in consumer, but if that is counter. And that's where where does that overwhelm? And that's where we see the consumer obviously getting worse. This is just looking at the Philly Fed non-manufacturing prices paid. So remember, you saw the S&P flash had service prices coming down. But when you look at Philly, non-manufacturing actually went back up. But again, this is those counterbalances that we're saying. It's that there's nothing here saying, oh, prices are exploding to the upside or, oh, prices are dropping to the downside. There are these competing factors, which is keeping us here, which is, again, keeping that level. Because it's not like prices paid fell negative and you see this contraction. It's staying elevated and staying strong. Richmond Fed Services came in at negative 15. Services outlook, again, came in at negative 22. So then when you look at the Richmond side and you look at the views in general, these are negative leading indicators, which should help bring some prices down, but also shows some slowdown in some of the pivotal areas of the underlying economy. Richmond Manufacturing Survey, current composite, October manufacturing index down to 3 versus the estimate of 3 and 5 in the prior month. New orders fell back into contraction. Wages accelerated sharply, which is prices paid ease. But again, wages rising is going to put that pressure on that price on the price paid side. Shipments still expanding, employment same as the prior month. October Philly Fed non-manufacturing index fell to negative 20.3 versus negative 16.6. Back in the downtrend. And this is that back and forth where there's still a lot of mixed data, which is why, to see that the flash PMI composite sat at 50, it's because it's like, well, there's some spots that are okay. There's some spots that are kind of weak. And it's just going to be that mixture of, well, which direction are we going in? It's still to the downside, but nothing goes down in a straight line. There's going to be months of more ordering, months of more activity because you still have a business to run. You still have inventories. You still have the orders to fill. They may be less, but you still have some that you have to go out there and take care of. Richmond Fed Manufacturing expected new orders slow down again. CapEx expectations, again, all of this showing that contractionary side. Obviously some of it is still in expansion. Richmond Fed manufacturing prices received continues to be at these levels. October Kansas City Fed, same as in prior month at -8. New orders fell further into contraction. Average work week at 0. So again, you're seeing that negative pieces overwhelming a bit, but again, it's just a matter of, is Kansas City more important than Philly? Is Richmond more important than New York? And this is why we look at the different pieces to see where is the general consensus, up or down. It's still down, but again, the rate of change is that pivot. This is just putting into perspective that manufacturing where, we're just kind of sucking around this negative level, which is where we believe we're going to be. CapEx expectations turning lower, and that's a bigger leading indicator again because you're not going to get company spending. As we said earlier, they're spending more on interest expense and interest rates and interest cost, which again is an underlying problem. Philly Fed manufacturing prices charged expectations move back up, which again is a net negative when you look at how this has to get recouped somehow, and that's usually that pass through, which we see bumping things back up. New York Fed service business activity rolled over, came in at negative 19.1. Again, more pressure in general. Americans struggle to afford car payments has gone up. The percentage of borrows at least 60 days late on their car is now coming above 6%. We've never been at these levels. When you look going back to 1994, we're now taking out the highs that we saw prior to 2020, back in 1998. All the while, housing affordability index is at a record low. So again, and this is the issue that a lot of people have, including myself. It's like, well, all of these things indicate, if you put them into a box, of the consumer slowing, but people and consumers have different ways of doing things. So typically they stop paying their car payments first, then they stop paying their credit cards, then they stop paying their rent. And that happens in that kind of lockstep order. So this is that leading spear edge of the pressure that's coming. But it takes time to see the consumer get to such a point that they have to admit we cannot continue to spend at these levels. Then when we look at U.S. existing home sales, monthly supply kind of flatlining at 3.4 months. Upside to September existing home sales report that was the monthly supply edged back up to the highest since June 2020. Decline in medium existing home prices was relatively short-lived with that bounce. And again, that's a bounce that the Fed can't tolerate. They can't let that happen because asset prices are going back up. They need to get in front of asset prices to really impact and get the way things need to be. Current drawdown in existing home prices now, and again, it's just the number sounds big of negative 40%, but you have to think about how ridiculously high it was. So, running up $100 and then coming down 40. When you think of it, you're still up. And that's I think the problem when you look at some of these things. And about 53,000 U.S. home purchase agreements were canceled in September, which equals 16.3%. So even though you have this talk about, well, there's more home sales, it's like, but are they going to close? What is the closing rate? Because a lot of banks are pulling out saying, you know what, we can't give this. We can't afford to give this to you because of these pressure points. Home buyers need to earn $115,000 to afford median price U.S. home more than ever before. And then when you look at the new home sales versus buyer traffic, that's where you're getting this disconnect. So then the question is, are the builders selling in bulk to retail investors, real estate investors? But then you look at real estate investors and it's like, well, there hasn't been a huge uptick. So this is going to be interesting to see how that rectifies itself, because some of the numbers aren't jiving, and that's why we do see more downside to pricing, especially as more volume comes to market. September new home sales came in at 12.3% month on month versus the expectation of 0.7. Median new home prices fell 12.3%. September pending home sales came in at 1.1% month on month versus -2. So again, the pending side is going to be interesting because you see that little bit of a bounce, but you're still at fairly low levels. And as you try to go get a mortgage and solidify that mortgage, there's a good chance that it won't follow through. And we have that chart in a minute. Slight convergence of monthly home supply for new homes versus existing, with the MBA US Purchase Index, so the mortgages, still remain at the lowest level they've been at since 2014 and falling. So again, it's are these people paying cash? Where are they getting the money? Which is why we see some of these disconnects. New listings tick up in September. Again, that's something that is going to be interesting to see how this goes. Largest increase since February of 2022. But in level terms, obviously still looking, fairly irrelevant. Even though mortgage rates DQ'd a big chunk of the market, 7 out of 10 agents still say buyers outnumber sellers. And it's funny because when you look at real estate agents, I've never met a bearish real estate agent. And even through 2008, when the world was falling apart, it's like, oh, great time to buy, which they were right. But in 2007, they would have said great time to buy. In 2006, they would have said great time to buy. So, it's always tough to see some of those expectations, which is why you have to, kind of weigh different things. With new one-family homes houses sold, new one-family homes months of supply, you kind of get this balancing act in terms of where the supply is. So again, there's some stability, but when we look at the market in general, we do expect some of this to trend lower, some of this to backstop. It's not going to collapse, just like the consumer spending. Home prices are slower than all at once. It's also going to be directed based on location. There are some areas that got so frothy from the southeast, the south, the southwest, that there's likely to be more to come out there because they ramped up so fast. And that's going to be an interesting one to watch as well. So that's what we have for you on this segment. In the next segment, we're going to go into Europe and some of the things that are happening within the European theater.